Hello and welcome to another Wealth Ladder video series. My name is Greg Kennan and with me I have Michael Mackinven. Today we're going to be talking about creating your property investment strategy. So that's a bit about how we find our income, where do we get our income from, different areas of that, and also the different property strategies that you want to start with, whether that's commercial property or residential property. Where should you start? What should you do? So Michael will be looking at that as well. So enjoy the video. Welcome Michael, and take it away.
Excellent. Thank you, Greg. And welcome again, everyone, to creating your property investment strategy. We use the word creating because it's not choosing, it's not saying this is the one strategy that I'm going to use forever. It's about creating a personalized strategy that works for you in your particular circumstance. So we'll get straight into it. The introduction. So today we're going to be talking about, first of all, the success formula. What is your IP? And the I of IP is income. And so where's that going to come from? And we're going to contrast job and business income with active property income. And then the P of IP is property. And this is long-term buy and hold property. So the capital gains and passive income from property. So we're going to talk about these. So here's the success formula. It's analyzing and working out what is your particular IP. And so on one side, you've got income, and there's lots of different ways that we can derive income in our lives. We can work in jobs, and we can also get income from property in trading strategies and the like. We're going to go into that in a second. And the goal of the success formula is to take as much income as possible after we've paid for all our expenses. We've got to live, of course. We've got to put food on the table and petrol in the car and send our kids to school, all those things. But whatever we've got left over, and as much as we possibly can, we want to send into the P side of the equation, which is our property. And this is our long-term buy and hold property. Property in itself does give us income, but often it's only enough, especially at the start, to pay for our expenses. It pays for our interest, it pays for our maintenance costs and our rates and management fees and those sort of things. There's not a lot of income left over. When we get our mortgages down, it does give us a lot more, but certainly at the start, we're wanting to increase our income as much as possible and to put that across into property. So let's have a look at how this works. So first of all, income. Here's some nice New Zealand dollar bills, some $50 bills and some $20 bills there. So let's look at active strategies for creating our income. So first of all, we all, or most of us, have a job or a business which we derive income from. We've got a couple of pictures there. We've got a cook and a fireman and a country and western singer. We've got a director or a filmmaker. What else have we got there? A construction worker by the looks, a business lady, and in the middle a lifeguard. So all these are jobs. You've got your own job as well. You earn income from somewhere. So we should be thinking about how can we increase that income a little bit more. How can we perhaps work a few more hours? How could we perhaps increase our hourly wage so we're getting actually more at the end of the week? We can all do things to make this happen, and this is really important. We don't recommend that you chuck in your day job right now to go and work in property full time. That's not necessarily a good strategy. It can work for some people, but generally that's not the best strategy. Generally, you're best to look at the good reasons that you're in your job. Why do you love your job and love it even more? So that's a really important part of investing, we feel. So your job or your business income. And then we'll look at a number of different active property strategies. So this is property for income. So in this case, we're going to be doing property with the aim of producing income from that property. So we're going to be selling it on or doing property finding and the like. So there's a number of different things. So first of all, we had our personal income and our job or our business, and now we've got income from property. One example of income from a property is doing a flip. So we will buy the property. In this case, we've got a pre-renovated property on the left-hand side. It's a nice pinky apricot sort of looking color there. And we've got a garage down the back that's looking pretty rugged. And on the right-hand side, we have a fully renovated property with a nice sleep out down the back. So this is a property that has been bought, it's been renovated, and then it's been sold. So that is an example of a flip. And again, a flip, and in this case, property finding as well. We've got contemporaneous deals and nomination deals. A contemporaneous deal, you'll remember, is when we have a contract to purchase a property and then we on-sell that property with another sale and purchase contract on the same day, contemporaneously sell that property. Or a nomination deal is when we have a contract to purchase a property and we nominate that contract on to another buyer. We go into that in more detail elsewhere, but property finding and the one we've just looked at as well, the flips, are examples of effectively a job. We're effectively trading time for money. What we're doing is we're taking a property, we're adding some value, we're doing something to it, and we're making some profit from that over a certain period of time. So it is effectively a job. So these are all active strategies. Another active strategy is a lease option strategy. We can look to rent to buy as another word for lease option. So the investor on the left-hand side here, very smart looking with his red tie, has bought a property. He's perhaps renovated, done some work on it, and then he's advertised it and found this lovely family on the right-hand side who are going to move into his property for a period of time, 2 or 3 years, pay the investor a certain amount of rent each week, and then on top of that they're going to pay him a certain amount of deposit each week. After a period of, let's say, 2 or 3 years, then they will purchase that property. They'll complete the transaction. It's an option to purchase transaction. They will then settle that property, and that property will be the family's. It won't be the investors any longer. So he's had it for a couple of years. He's made a certain amount of profit. So this is also an active strategy. It's not a long-term buy and hold strategy. He needs to spend time to create this income. A sandwich lease option is a more advanced strategy of the rent to buy or the lease option. A sandwich lease is whereby the investor would lease the property off an original owner. The investor wouldn't go on the title. He would then option it on to another buyer. But it's a strategy we don't recommend. It's a very risky strategy, and it takes a lot of time to bring together as well. So anyway, that's an example of a lease option, of another strategy that we can use to develop income. Here's one more strategy. It's a big backyard strategy, and this is where we would take a property with a big backyard and we would build a minor dwelling or some extra buildings. So we're looking to add value where it didn't exist in the past. This is an example of an active strategy if we're selling on this property. If we're not selling on the property, then it's an example of a buy and hold strategy because we're gaining extra cash flow from this property and not selling it. So this we've got on the left hand side and the income side, because we're assuming that we've added some value, we've put on a minor dwelling, we've got the rent up, and then we've sold this property on for a profit. So in that case, it would certainly be an income strategy. Here's another example of a income strategy. This is subdivision. So a developer has bought a certain amount of land, gone to council, gone to an architect, got all the gone to a surveyor and the like, and got some plans done up, and they could potentially sell this subdivision off the plan. So it hasn't been developed yet, and they could sell it on to builders or homeowners or the like, and they could then sell it down and make their profit. They could also subdivide it and do the development as well, which is the next one, so they could actually develop that property as well. Here's some nice townhouses in Hamilton, I believe. Very nice looking 2-story single garage properties that have been developed. In most cases, generally, the developer would sell on everything that they've built. They would occasionally hold on to 2 or 3 properties, but generally they'll be selling them on, taking a profit, and then moving on to the next deal. So it's an example of effectively trading time for money, but generating very important income that we can then use to live our lives and also to put into property as well. So there's some other property related strategies that we can talk about, and these are property related strategies for income. They are not directly involving property, and they're different to, of course, your job, but they are indirectly related to property. So one of those examples is property construction. So we could have a team of tradespeople. We decide that we're going to do some renovations, or we're a plumber, a tradesperson, we're a plumber or an electrician, and so we're going to do some work on properties for a fee. Similarly, property services. We could be in property sales or property management, or in fact property valuations, and there's other property services as well. For example, accounting and law. We could work in the council, in the property division. We could be a finance broker, or we could work as a banker in the property department as well. So all these are jobs that are related to properties, but we're earning a direct income. So these are examples. If someone was really interested in property, they didn't want to go property full time, they had a job that perhaps they wanted to get out of and move closer to property, so we could go into real estate, for example, or property management, and that wouldn't be a big leap to be able to do that, but still get income from that. So we've seen the I. This is the left hand side. The IP of the I, remember, is income. And so where are we deriving our income from? And your particular situation, you need to think about where you're getting your income and obviously increase that as much as possible. So are you in a job? Are you working in a business? What are you doing in property? Are you property finding? Are you doing trades, doing flips, buy a property, sell a property, make some profit? All those are very good things. On the right hand side of the equation, we've got the P, which is the property. So this is where the true investing happens. This is where we make our money in property long term, and this is a passive strategy for capital gains and income. If we look at the right hand side, we can see a card here. This is from Monopoly. You'll be probably familiar with Mayfair. This is the most expensive property on the game of Monopoly. So you go right round, and just before we go past go, we hit Mayfair. This is a very old card here, but if we own the site without any developments on Mayfair, then if someone lands on our property, then the rent for landing and staying on our property is, in this case again very old, £50. So if we build a house, then how much do we get then? Well, we see we get £200. So we've added some value to our property. Perhaps time has added some value. Inflation has increased the rents. Perhaps locally a train station has been put in, and so we're getting some economic rent on the back of that infrastructure that's been put in. So the rental income we derive from this property goes up over time. This is the key to long-term property investment. This is what we're looking to achieve with property. So long-term buy and hold properties. Here's some different properties. These are mostly residential. We do have a commercial down the bottom left, and we've got a subdivision on the top right there where someone's putting a minor dwelling, or perhaps they have subdivided a property and they're looking to put another house on there. These are all examples of long-term buy and hold strategy if we're not looking to sell these properties. And so let's look at where a new investor might start with a long-term buy and hold strategy. So here's a couple of properties. We've got one on the right hand side there, nice brick property. It's not tile, it's brick and long run iron roof with nice big section. And on the left hand side, looks like we've got a 1960s probably weatherboard home. Again, very good condition, very nice property. These are ideal properties for a new investor. We're just taking out the area right now, or the town, where we're just looking at the property itself and saying how do these stack up for a new investor? And they're perfect deals. They're very low risk, meaning that we're very likely, as long as there's a good population in that town and there's good employment and all those sort of things, which we've talked about elsewhere, as long as we can rent this property, it is going to be low risk. So we can always, if someone moves out, we can always get someone else in. The banks are going to lend to us. We only have to have a small amount of capital to buy this property. In Auckland right now, as we speak, it is a 30% deposit. Outside of Auckland, it's a 20% deposit. It's a lot less than commercial. So it's they're nice little properties that we can get into. The other thing is that we understand them. As people that live in homes ourselves, we know what it's like to rent a property. We know it's like to live in a property. We know what it needs. If something's broken, we can go in there and we can use our common sense to fix that problem. So very good entry level investments. Often investors will then progress on to what we call multi-income residential properties. On the left hand side, we have a nice 3-bedroom, again probably a 1960s home, and in the back we can see a garage, or perhaps it was purpose-built minor dwelling, or a unit there that's been rented out. And so we have a couple of income units on that property. On the right hand side we have a block of flats, and that will be a number of flats that are in that building, all rented out to individual renters. Both are examples of multi-income residential properties. Now these are really good for a slightly more advanced investor, because the purchaser of these properties is only going to be an investor. Generally, the left-hand unit might be a homeowner, but the right-hand purchaser is definitely going to be an investor. So that means the price is going to come down a little bit, and also the yield's going to go up a little bit, which is great for us as investors. So why would a homeowner not purchase the right-hand unit? Well, they very unlikely to. They'd only be able to live in one of the units and then have to rent the rest out. So it's very unlikely. So we've got less competition, and that's a really good thing. Also, these are really good. The left-hand unit certainly would be classed as, even though it's got two incomes, as a normal residential property. The right-hand unit, from a finance perspective, would potentially be classed as a commercial if there was enough units in there. So we might find we have to put a little bit more money in as a deposit, but we've still got relatively low risk. We know who our tenants are, we know where they're going to come from, we can fix any problems in these houses, no issues. Then investors will often move on to small commercial, and small commercial would be in the market right now anywhere between, let's say, $500,000 and up to say $3 to $5 million would be a small commercial. And there's a lot of advantages in commercial over residential. So we have the advantage of the OPEX is paid by the tenant, so it's a lot lower management. For example, a single investor could potentially own up to, let's say, 20 or 30 residential properties. Not too much problem. It would start to get quite a bit of management time and effort into managing that portfolio, but it's quite feasible that a single investor could have 20 to 30 properties, whereas it would be no problem really to have 20 or 30 commercial properties as a single investor. There are some risks, some big risks as well. If the property is vacant, that's a really big issue. The rates, so the interest costs, are slightly higher, and the capital input that has to go into these properties is higher as well. So we need, if for example we're purchasing a $3 million property, then we'd need, let's say, 40%, so we need well over $1 million that's going into this property as capital. So it's not really suitable for a smaller investor, but it's something that we want to ultimately potentially aspire to. And then we have larger commercial, and this is just a flow on from the smaller commercial. We get much better yields when we're over, let's say, 5 million up to 10 million. We're getting better yields, we're getting good properties, and often much better tenants as well. And then finally, we do have something in here just for the exercise and for fullness of this video, something on land banking and land leasing as well. This is a very advanced strategy, both of them. Land banking, you need very deep pockets to be able to do this, because of course there's no income on this property. So we would purchase it with the view of subdividing it in sometime in the future. We might have some holding income, a small amount. For example, this one here might be a little grazing block, so we might get a couple of dollars from grazing some heifers or some cows on this property, but it's going to be negligible. The other advanced strategy that investors will often look to move towards, but we're talking let's say 20, 30, 40, 50 million dollars of assets, that sort of level, then people will start to look at owning the land only rather than owning the buildings. Big tracts of London, for example, are owned by families that have held them for many, many generations. They've been wealthy families for hundreds of years, and they just lease out the buildings. So people, or lease out the land, sorry. So people will own the buildings, but they won't own the land. There is a lot of lease land in New Zealand as well, a lot of that individual investors cannot buy, but also a lot of land that is possible for just normal investors like you and me to purchase as well. Of course, leased land requires huge amounts of money, and the returns are quite low, so it's certainly not an easy approach or a starting position for investors. We just add this in for fullness so that you understand what the big guys and the big girls are looking to do. So in summary, remember we've got our INLP, So you need to identify what is your income. And I've got in here, love your job. And sometimes we're in a position where we blame the boss. So the boss is a horrible guy or horrible lady, and we don't like our colleagues and all the different things that we talk about our job. But often we can actually look for good things in our job, and we can look to do a better job. And if we're looking to always be of more service to people around us in our job and everything that we do in our life, we're going to be very successful. And so it starts with our job. So I really do believe that we should be the very best we can in our job, and then when we've done that and it's truly the right time to be moving on, then we'll know that. And so we can certainly move on at that point into full-time property, doing the strategies that we've talked about. But identify your income. How can you make a little bit more, and how can you divert a little bit more of that income into long-term buy and hold property? That's what's going to make you the most money over the long term. And then we look to identify and learn some active property strategies. Do you like buying, renovating and selling? Do you like doing lease options? Do you like property finding? Perhaps you want to develop a database. You really enjoy marketing, and so you want to develop a database of 1,000 people. Every time you find a nice deal, you can nominate that deal on. Great strategies for people getting into property to develop income, to be able to hold on to those other properties. Then that's the buy and hold properties that we're ultimately looking to do. That's where we're going to make our money. And then lastly, we're looking to move up the property ladder, slowly build our portfolio, get rid of properties that no longer work for us, and consolidate into higher value properties, into better properties that are going to yield us more and enable us to achieve our goals over the long term. So I hope that was of good value. Thank you very much for listening. We'll talk again very soon. Bye for now.